This short video forms number 2 in my short 3-part pension series. So in the last video, we looked at the looming pensions crisis. In this video, I want to look at the bare bones of how pensions currently work. In the next video, I'll look at what's changing in April 2015. Big day. So, the basic problem. Once we start working, why do we need a pension? Once we start working, we've got to live off something. We're not going to have a salary, I haven't got an employer anymore, so what's it going to be? Some options, the state. And we'll look at the state pension in a moment. 2 problems with relying on the state. 1, no one guarantees there will be a state pension when I retire. Hopefully there will. Number 2, it's not that much. Number 2 is property. Some people say I'll just use all the money I've got to do buy-to-let or something and take rental income. Well, if you're the kind of person that can live with all the headaches of owning property and you're prepared to live with those until you're 70, 80, 90, as well as the risks, and there are many of them which I deal with in another video called the pros and cons of property, fine, but it is not an asset for everybody, particularly not as you get older. So, for a lot of people, the lower hassle option, the more standard option, is some kind of private pension. And I want to have a look at the bones of 2 types. The increasingly rare defined benefit scheme and the more common defined contribution scheme, also known as money purchase. So, state pensions first of all. You could just sit back and go, well, the government will look after me. And to an extent, you're right, but they're not going to throw money at you. The current state pension is around £113 per week, and that's sort of the most it can be, for one person, if you like, assuming you've made sufficient national insurance contributions over your working life. Right, so if you've been employed making contributions over a decent enough length of time, you'll qualify for that. Now, you can supplement it with a second state pension if you weren't advised to contract out. Some people contracted out, contracted back in again, but you can supplement that up to a maximum of around another £160 per week. But even so, you're not talking fabulous life-changing sums. Yes, in retirement, certain costs reduce. You're not going to be commuting to work anymore. Perhaps you don't run a flash car. All right, perhaps you're not paying the mortgage. Perhaps the school fees are gone. But most people want to have some fun in retirement, want to be able to pay for those trips, want to have a lifestyle. And the state isn't really going to cut it by itself in terms of providing a pension. Current age, that's another factor, is 62 for women, 65 for men. That may well rise in the future. It's almost certain to rise. When I get to retirement, highly unlikely they'll be able to take a state pension, even if it exists in the same form at 65 years old. The other thing to worry about with state pensions is they're unfunded. They are paid out of the current contributions taxpayers make to the Treasury. So who knows whether there'll be one in the same form when I retire, when you retire. Who knows? Nothing's guaranteed. So, defined benefit pensions. Now, a lot of people are fortunate enough not to have to worry too much about the level of the state pension because they've got a very generous defined benefit scheme, but these are increasingly rare. Here's how they worked and still work for the lucky people who may still have one. So contributions go in on the left-hand side. In basic terms, there's a pension fund in the middle, and at the end, when you get to your specified or chosen retirement date, out comes a defined benefit. Now the name does what it says on the tin, known as final salary, because the benefit you get out is literally linked to your final or sometimes average salary. If you're really lucky, it could have been 2/3 of your final salary, or maybe half of your average salary. The point is the benefit's defined. You know what's coming out the other end. And the reason the state and employers don't like that is because it puts all the risk on the left-hand side. They've got to worry about what happens if there's a shortfall. And just to give you a little flavour, a shortfall is where the fund has been buying equities, it's got assets. So if you were to add up the assets of the fund and get, say, 100 million, look at its future liabilities, I'll call them liabs, and that's 120 million, let's say. You've quite literally got what they call a deficit of 20 million. You've got a shortfall of the difference. All right, so the scheme hasn't got sufficient assets to cover its liabilities. And where an actuary declares that, basically, cap in hand, over here, the employer's got to do something about it. Shovel in some more money, come up with the solutions. All the risk is over here. The employee just sits there waiting till they've done their 40 years and takes out their defined benefit pension. So not surprisingly, those are being shut and replaced with defined contribution schemes, also known as money purchase. And this is where the risk transfers from the left to the right. As follows. In goes a defined contribution this time. Now that means a fixed proportion of your salary, for example, from an employer. You might put in, say, 5%, they put in 5%. So the money comes from somewhere, you and or your employer. It goes into a big pot in the middle, a pension fund, and then on the right-hand side, you get out whatever you can get out, because you don't know what that fund's going to be worth, and no one's guaranteeing its value at retirement. And in fact, what that fund's worth is a function very simply, of the contributions that go in, the bit of tax relief you get on top, that's quite nice, more about that in a moment, any growth that's achieved in the underlying investments, minus charges. But you don't know how much that's going to be, so you don't know how much you've got to hand over to a life insurance company to buy yourself an income stream at the end of it. So all the risk now sits with the employee. The employer is only responsible for shoveling in their fixed defined contribution at the front end. After that, your problem. Now then, key factors. So what's going to influence, given that most of us or many of us have this style of pension now, or are being sort of forced into it, if you like, as the old style closes, key factors that will influence how much you have at the other end. The size and number of contributions. The earlier you start, the more you put in, the greater the effect of compounding. Number two, the growth rate achieved. All right, the past is no guide to the future, but the higher that growth rate in terms of what's in the fund while it's in the fund, the better. How long the fund is allowed to grow, and finally, charges and costs will obviously have a bearing over the plan term. All right, but the point being, none of that is known with any degree of certainty, or most of it, until the final roll call when you cash in the fund. All right, so make sure you start early, try and get a decent growth rate if you possibly can, and give compounding as much time as possible to work. Now, an example of how it could go right for you, if you like, making some assumptions. Were you looking at, let's say, 3% versus 5% versus 7% growth for £250 per month over 40 years, and you'll be glad to know that some of that can come from the government. So £250 per month over 40 years at a relatively conservative growth rate, a sort of middling growth rate based on history in the UK stock market, if you like, and a slightly more aggressive growth rate. Where could you be? Well, the amount you've paid in, physically paid in, is the green bars there. All right, just cutting across. That's the amount you've paid in, £250 per month over 12 months times 40 years. But where you could be if you get growth inside the pension, and most of the growth inside the pension is tax-free, by the way, inside the fund, well, at 3% after 40 years, a fund of 229,000, 372,000 at the end of 40 years at 5%, and a decent 621,000 at 7%. All right, so the growth rate is clearly fairly key, and that's why anyone in a money purchase style of pension plan should keep an eye on what they're achieving and look at the projections they should be provided with going forward as to where they might be at the end. But you can see at a decent enough growth rate over a long enough period, even relatively small amounts can turn into a decent, potentially decent pension fund. Now, tax basics. Another reason to have a pension, if you like, is you do get some reasonable tax breaks. Aside from the fact you've got to retire on something, the tax position isn't too bad at the moment. So if you're an investor, opening up a self-invested personal pension, for example, looking to retire at some point in the future, here's the deal. You get tax relief on the way in. What does that mean? It means that if you're a basic rate taxpayer, every 80p that you put in becomes £1 effectively invested in the pension. There's a 20p top up from the government. If you're a higher rate taxpayer and you play it right, 60p can effectively become £1, although the mechanism for claiming that is slightly different. All right, so that's quite good news. On the way out, your pension is taxable though. Okay, so that's something to bear in mind. But in the middle, the investments you put within a SIPP wrapper, and it's quite a wide selection now, equities, bonds, funds and so on, can grow there basically tax-free. So fortunately, a little bit of help is at hand in terms of how you try and build that retirement pot. Now, once you get to the end, basic pension choices. Now I'll cover these in a bit more detail in the next video, but your basic choices are as follows. You can take the cash out. At the moment, 25% can be withdrawn as a tax-free lump sum. You can buy an annuity with the rest. All right, a lot of people go down that route because they don't want to go down the third route, which is income drawdown. So you basically convert the remainder of the money that you've got into an income stream by handing it over to a life assurance company. Or option 3, you can do something called income drawdown. So you leave the money invested and take off an income instead, which has the advantage that the pot stays invested. You don't lock in the level of income at that point in time, and so therefore the income and the pot might grow whilst you benefit from it. Problem at the moment is the options on the right in particular are subject to some quite tight restrictions. So I'm going to cover those just now. This is just the bare bones, and we'll come back to this in more detail in video 3. A side-by-side comparison of annuity and income drawdown, just a real top-level summary. These can kick off currently from 55, although watch for that age to go up in the future. It pays a taxable income for life, so you haven't got to worry. You will get an income from a life assurance company from the moment you hand over the money, if you like. Choices include having that income linked to inflation. That obviously costs a bit more in terms of what you get for your pot, and a minimum guarantee period. That's just, in case, for example, you were to die 2 years into the plan, what would happen in terms of payments from the plan, let's say. And the amount depends on health and lifestyle factors. So you need to take those into account. Health and bad lifestyle factors will potentially boost the amount you get, because the reality is the life insurance company don't expect you to be taking the income for as long. And annuity rates vary. In other words, when you get to the point where you're cashing in your annuity, bear in mind that thing called the open market option, which is essentially shopping around to get the best annuity rate you can. So if you've got £100,000, make sure you're looking at all the available providers for that £100,000 income stream, not just the one that you're currently with. Income drawdown, by comparison, more on this in the next video, again can kick in from 55 at the moment, allows you to keep your fund invested and draw taxable income off it. Unfortunately, for people who haven't got enough other sources of income, the amount you can draw off is capped by the government actuarial department limits. If you want full flexibility at the moment, you have to have a minimum income requirement from another source. Now that's going to change in April, but at the moment there are some restrictions around who can go for income drawdown. So the default for other people is the kind of annuity option. So as I say, watch this space for what's coming down the road very shortly. That leaves us with the April 2015 changes. That was a very basic summary of how pensions work and some of the choices available when you get to cash them in. Next video, the big changes, some of the biggest we've ever seen.